Better System Trader, episode 26.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 26 and I'm your host, Andrew Swanscott. This week's sponsor is TradeView Investments, a privately held proprietary trading firm located in Melbourne, Australia. Their team of professional prop traders specialise in trading equities, futures, options, FX and money markets on multiple exchanges around the world. They're a technology-focused firm with a systematic approach to trading, deploying up to 12 different proprietary trading strategies, including directional trades, arbitrage, hedging, momentum, breakouts, reversals, and scalping. If you'd like to know more about TradeView Investments or how to build your own automated trading systems like they do, head over to the show notes page at bettersystemtrader.com/26 to find the links. Now onto the show. The guest this week is Robert Carver, an independent systematic trader, freelance writer, and research consultant. He spent more than 7 years working for one of the world's largest systematic hedge funds. When he left, he was managing a multi-billion-dollar fixed income portfolio, and now he trades his own money using systems he has developed himself. Robert has just released the book Systematic Trading, a unique new way to make investment and trading decisions. In this episode, we discuss trading rules, what makes a good trading rule, and the advantages of using continuous rather than binary rules. He also shares insights into overfitting and the challenges and perils of walk-forward testing that can make it impractical. Anyway, let's get right to it. I hope you enjoy the chat with Robert Carver. Thanks for joining us today, Robert. If we could please start by just sharing your trading background, how you got into trading and the journey up to this point.
So I first started trading in 2002. I got a job with Barclays Capital, which was the investment banking arm of Barclays Bank in the UK. And I was on the exotic interest rate derivatives desk there for a couple of years. Didn't enjoy that much, to be honest. I think one of the reasons I'm a systematic trader now is I'm not a very good discretionary trader and I didn't really enjoy doing it. So I spent a couple of years working for a research think tank, so a complete change away from trading entirely. And then I was fortunate enough to get a job with AHL, which some of your listeners may have heard of. It's a large systematic CTA, commodity trading advisor, a large hedge fund, using purely systematic quantitative models to trade mostly futures, but also other instruments as well. And the first job I had with them was to develop a new kind of model, which was a fundamental model. So AHL, like a lot of CTAs, mainly a trend follower, so mainly using purely technical price-based signals. And they wanted to diversify away from this. So they brought me in because I had an economics background and to develop models that looked at fundamental data, so macro data and micro firm level data to make forecasts instead of just the purely technical stuff. Did that for a few years with AHL, and then I was put in charge of the fixed income portfolio. So this was all fixed income trading, regardless of whether it's technical or fundamental, covering bond futures, short-term interest rate futures, interest rate swaps, cash bonds, and also credit derivatives. And I did that till 2013. And that was quite a large portfolio. So you're talking about risk in the hundreds of millions of dollars a year. And I enjoyed it, and it was interesting, and I learned a lot. But I decided in 2013 that I'd sort of had enough of fund management as a job, and decided to take a break. And while I was taking a break, I started trading my own money. Decided to implement my own fully automated system, which perhaps we'll talk about more today, to trade my own money. And as I was doing this, I kind of got back into the research and the thinking about the subject. And I've recently written a book on systematic trading. And that's where I am now. So just really looking to help people, educate people, think about the subject and understand it more. But from the point of view of both institutional and now I've had a couple of years of retail trading experience as well.
Yeah. Okay, great. So as you mentioned there, you've just released a book, I think, in the past few weeks called Systematic Trading, which I think is a fantastic book. So congratulations. And in that book, you raise a number of interesting concepts that perhaps some traders have never considered or been exposed to before. So I'd like to discuss some of those with you today. But first, let's just cover some of the basics leading up to that. So if we can just start with trading rules. Obviously, trading rules are an important part of systematic trading. So what makes a good trading rule?
I mean, the basic idea of systematic trading is that you're going to be doing something a repeatable process. So something that you can test would have worked in the past. Some people say, I use trading rules, but they might look at a chart on the screen and say, well, look, there's a pattern there. But unless they can actually write down an algorithm that can identify that pattern, a rule that someone else could use or a computer could use to identify it, then that's not really purely systematic. So you're looking for a rule that you can test. And the reason you want to test it is you want to see whether it would have worked in the past. And then you're essentially making a big assumption, which is that if the rule worked in the past, then nothing has changed that much and it will continue to work in the future. So that implies you want a trading rule which isn't overfitted or curve fitted, as some people would say. You want something that's going to work in a variety of market conditions. This is my opinion, at least. And you want something that is relatively simple, I believe. More complicated rules are more likely to have been overfitted. Relatively simple rules, less so. And the other advantage of a relatively simple rule is that you can understand it. You can understand what it's doing, and you can kind of predict what it's doing. So you don't just have a black box under your desk that's saying buy or sell, and you look at the price and you say, well, I don't really understand why it wants to buy or sell here. I don't really understand what that rule is doing. So for me, it's really important to have rules that are simple as well, and to have rules that I can intuitively understand. So, I mean, let's take a very basic rule, which is a trend following rule. You can say, what does a trend following rule do? Well, it says that if the price has been going up, it'll carry on going up, and vice versa. That's a very easy idea to understand. If I had a very complicated rule, I wouldn't be able to explain exactly what it was doing, exactly understand what it was doing. And that means its trading behavior might be unpredictable. I'd be less happy trusting it. The other thing is that if I have an explanation of what a rule's doing and an understanding, then I might be able to identify a situation in which that rule will no longer work. Whereas if the rule is doing something very complicated, then that's less likely. So simplicity, robust and not overfitted, understandable, and with a kind of underlying explanation. Those are the things that I personally like to see in a trading rule.
Yeah, that's great. So you've touched on some reasons why trading rules don't work, but why do you think certain trading rules are profitable?
I have a fairly brutal view of the world, in the sense that I don't really believe there's actually a lot of alpha out there. I don't really believe that there are a huge number of trading rules that exist, which are kind of, doing something extraordinarily interesting and going to make you lots of money. What I do believe is that there are a lot of things out there that happen persistently. Now, economists would say, well, you've got risk factors. You've got things like the equity risk premium. So generally speaking, equities outperform bonds because they're riskier. You've got things like the term structure premium. So generally speaking, bonds that are mature longer in the future will outperform bonds nearer in the future, because people are less happy about lending money for 10 years than they are for 5 years. And you've got all of these effects in the world. And some people would say that they kind of lie somewhere between beta, just getting the market return, and alpha, doing something extraordinary that requires special skill, and you could call them alternative beta. So I personally like to put into my portfolio things that aren't necessarily a surprise to people and are kind of very well-known effects. So it's a fairly well-known effect that trend following works, that momentum seems to work a lot of the time across fairly wide variety of assets and time frequencies. And this is such a well-known effect. You can't really say it's a secret. You can't really say it's alpha, and you can't really say it requires any special skill to exploit. So I'm really looking for things that I think have been around for a long time and have a kind of plausible explanation, and which aren't necessarily unique or novel. And there may be some stuff out there like that, but it's probably in kind of parts of the finance space that I don't myself understand that well, like maybe high frequency trading. But certainly in the kind of medium and longer term, I don't think there's any big secrets out there to be discovered.
Okay. We're actually going to come back to trading rules a little bit later, but I think if we can just have a couple of minutes talking about testing. So when we're testing trading strategies, there's obviously a number of ways to segment the data to see how the strategy worked over different time periods. And one of the most popular methods is walk forward testing or rolling window back test. Now, there's an interesting section in your book called When Fitting Goes Bad, which discusses this testing approach and how the most common applications of it may not be as effective as some other alternatives. I mean, you've got the results of a study there which are quite surprising. So perhaps could you give us a quick explanation on the testing approach and then share the result of your study with us?
Yeah, so there is some good things about the rolling window or the walk forward approach. So one good thing about it is that you're not cheating, you're not looking into the future. So you're not doing any kind of in-sample testing. So that's a good thing, clearly. The bad thing about that approach is you're obviously using a certain amount of data to fit your model, and that amount of data stays the same. So you might say, well, I'm going to use a year of data to fit my model, and then I'm going to kind of walk forward a year in my history, and then use the next year of data to fit my model. And the problem with that is that a year is a very, very short period of time to actually find any sort of statistical evidence about whether something is working or not. You really need much longer periods of time to sort of ascertain whether you've got something that's probably quite good, or whether you've got something that in one particular year just happened to have a stroke of luck and did really well. So I have data in my book showing that you need to have probably at least 10 years, and ideally much longer than that, of data to decide A, whether a particular trading rule is profitable, and B, whether a particular trading rule is better or worse than another trading rule. So if you're doing this kind of walk forward testing, you really need to have windows that are so long that in practice the walk forwardness becomes a bit of a moot point. Because I mean, if you imagine, you say, well, I really need 20 years of data to make a sort of good statistical judgment, and you start your back test in, say, 1980. Well, for the first 20 years of that back test, you're not going to be moving forward. You're going to be using what I call an expanding window, where your data set starts in 1980 and then gets bigger and bigger as you discover more of it as you go through the back test. And then only, obviously, after the year 2000 would you have 20 years of data, and would you actually at that point be moving forward in time. So in 2001, you'd be using data from 1981 to 2001 and so on. So there's nothing inherently wrong with walk forward testing. It's just that the size of window you need relative to the length of most people's back tests makes it a little bit impractical.
Yeah, and I guess as well, a common approach to using walk forward testing is just to pick the best variable over that test period and use that in the next. But you've done some research and identified that perhaps that isn't the best approach. Can you share some of that with us?
Yeah, sure. So the problem is that if you have, let's say you have a set of trading models that are all fairly similar. So you've got maybe one parameter you're changing, and you essentially say, well, I just want one of these trading models, because why would I need more than one trading model? I mean, it's ridiculous to need more than one, right? Particularly as they're all fairly similar. Just one parameter is different. So you start your testing process, and you, as you discover more of the data, you say, well, I'm going to let's say use a 5-year window. So you say, well, I'm going to use all the data from the last 5 years and pick the best trading rule I can. Now, what you'll tend to find is that the trading rule, specific trading rule that you're using, will change from year to year. So things are pretty unstable. There isn't necessarily one great trading rule. And a trading rule that's done really well for the last 5 years, it's not necessarily going to do that well for the next year or next 2 years, or next 5 years again. If you just did something really, really simple and said, well, I'm not even going to bother trying to pick the best trading rule. I'm just going to take all of these variations and just take an average of them and use that in my portfolio. That outperforms by some margin. And I've done this test in a number of different ways. That will do much better than the approach of picking a single trading rule. And what that's telling us is that trading rule returns are pretty noisy from year to year or even over longer periods. And it's really hard to pick out which one is the best. And by far the best approach is just to take an average.
Oh, that's interesting. So you're suggesting that rather than using the best rule or variation, you're really looking at the correlation between the variations and ignoring the actual performance metrics. Is that right?
Yeah. So correlations would come in a bit earlier in the selection process. So let's say you have a lot of trend following rules that are very, very similar. You're probably going to find that quite a few of them have very, very high correlations, like more than 99%. Now, although I said you should take an average of lots of trading rules, there isn't really probably a lot of point in taking an average of a lot of trading rules with an average correlation of 99%. You can just pick a number of trading rules out of there that have lower correlation, 80, 90, 95%, depending on exactly what data you're looking at. And as long as you pick a reasonable number of them, and they're kind of spaced out, if you like, amongst the parameter space, which if they're less correlated, they will be, right? So the closer the rules are in terms of the parameters they have, the more correlated they will be. So as long as you've got quite a few of these things, and they're reasonably spaced out, and you just take an average of them, that's a very robust method. You do end up with more than just the one trading rule, but on the other hand, you don't need to have an average of thousands and thousands of these things.
Okay, so when you say that you're taking an average of trading rules, do you mean like a different length of moving average, or is that what we're talking about here?
Exactly, that would be a very good example. So if you take a moving average crossover, so this is a rule that most people are probably familiar with. So you take a fast moving average with some look back, let's call it X, and you take a slow moving average with a look back of Y. And your trading signal is basically the moving average X minus the moving average Y. So these numbers X and Y can take many, many different parameter values. For the sort of reasonably sensible trading rules that on daily data, you're talking about X could be between 2 and 250, say, which is obviously about a year of trading days. So that's quite a big space to explore. But the vast majority of those things are very highly correlated. So something like, say, X equals 5 and Y equals 20 is going to be 99.999% correlated with X equals 5 and Y equals 21. So you don't need to have both of those guys. You can select trading rules which are sort of spaced out. And it turns out, if you kind of look at a big load of these things and you look at the correlations, then in the particular example of moving average crossovers, every time you double the length of the moving average, you're kind of moving the same. You've got things that have got the same correlation. So, for example, something with X of 5 and Y of 20, if you compare that to a crossover with an X of 10 and a Y of 40, those things have got about a 95% correlation. It's probably worth including both of them. And then you kind of jump up again to X equals 20 and Y equals 80. And again, that will have about a 95% correlation with the previous model. So that in that particular example, that would be a way of selecting a group of trading rules that's fairly representative, covers the space that you're working in, without having things that are really, really highly correlated. And taking an average of those would give you a pretty robust system.
So when you say you're taking an average of those, are you, because obviously some of those are probably going to perform quite poorly over a certain test period and some are going to perform quite well. Are you talking about weighting the averages here, or?
Yes. So let's think about the weighting problems. The weighting problem is essentially a portfolio construction problem. And in any portfolio construction in finance, you've got three kinds of inputs. You've got the correlation between the assets, which we've already touched on. You've got the expected average return, and you've got the volatility of the returns. Now, the way that I construct trading rules means that things are expected to have the same volatility, so we could ignore that for the moment. Now, if we think about the expected average return, then that's the difference between two things: the return before costs and the costs. And obviously, if you difference those, you just get the return after costs, which is what we care about, because unfortunately we all have to pay trading costs. So the key understanding, I think, that people perhaps don't appreciate, is that if you look at the returns before costs, these are very noisy statistical things. So it's really, really hard unless you have a lot of data or some trading rules that are, one of which is amazing and one of which is absolutely appalling. Unless you have that situation, you're very rarely going to find in your data that there is a statistically significant difference between the average return of one trading rule and another trading rule, at least before costs. Now, if you then say, well, let's bring costs into the equation, costs are actually fairly predictable. You can look at your system and say, well, on average I'm trading, this many futures contracts a year. Each one is going to cost me about this much to trade. Multiply those numbers together and I've got a pretty good idea of what my costs are going to be. So obviously that's going to penalize trading rules which are relatively quick if you're trading something that's relatively expensive to trade.
Yep.
So we kind of end up in a situation where the information that really matters is the correlation and the costs. There isn't really a lot of statistical significance in other data to kind of go beyond that. So what that means is, in terms of putting the weights on your trading rules, if you're trading something that's relatively expensive, like say an interest rate future, well, the Australian interest rate future is one of the most expensive futures I trade. Nothing personal, it just happens to be.
Everything's expensive here.
Exactly. But if you're trading that, then you're probably going to be putting more weight on relatively slow moving averages, if that's what you're using. If you're trading something really cheap, like say the S&P 500 futures contract, you could put more weight on the faster stuff. And then you look at the correlation, and the effect of the correlation is that things that are more diversified get a bigger weight. So if we just think about a simple moving average space, the moving averages that are kind of in the middle, like medium speed, if you like, they'll have a little bit of a lower weight because they're going to be correlated with the faster moving average and the slower moving average. But the faster and the slower moving average are going to be a little bit less correlated with each other. So that's the effect the correlation will have. So you will have slightly different weights, but they wouldn't be as extreme as if you'd done something like pick a single trading rule, which obviously means you've just got 100% in one asset, or if you've done a kind of sort of naive portfolio optimization using your data and assuming that the information in the data in terms of what the returns are was kind of more significant than it really is.
Okay, thanks, Rob. So you've mentioned a couple of steps we can take to avoid overfitting. For example, the granularity of variations and the length of the test period. But are there any other steps that we can take to try and avoid overfitting?
A very easy way to avoid fitting is to do no fitting at all. And this always makes people laugh, but we kind of, as I said, most of the trading rules I'm using are kind of fairly well-known things. So they're trend following. They're things like carry. There's if you think about equities, then you've got things like momentum. You've got value factors. If you think about foreign exchange trading, again, you've got carry and trend factors. So these are all things that I kind of already know work.
Yeah.
So if I back test or fit them, all I'm going to do is validate that I haven't chosen things that are crazy. So the fitting process has almost no value unless you've managed to find a trading rule that is so absolutely appalling, and you've got enough data that you can actually say in a statistically significant way, yes, this rule is so bad it's not even worth thinking about including in your portfolio. So I think most people do far more fitting than they need to or should do. And I think that's because people believe that there's more alpha out there than there perhaps really is, and they just need to keep on fitting and keep on, polishing their trading rule until the Sharpe ratio is at the level where they think it should be. And I'm not completely sure that's the case. I think doing that you just end up with something that's probably overfitted. So that's the first thing you can do is not bother at all. Just in terms of general techniques, I mean, I'm a great believer in simplicity. Things like machine learning and big data are obviously very very popular nowadays. Don't get me wrong, if you're an expert in machine learning and you can analyze some financial data and come up with a trading rule and make money, that's fantastic. But I'm wary that people who are less experienced might be using some kind of fitting technique they don't really understand, and they don't really understand whether what they're doing is overfitting. It's sometimes, if it's the more complicated the inside of the black box is, the harder it is to know whether the black box is really doing the right thing or not. So I would personally use a technique that you are comfortable with and that you understand, and you that's kind of at the level of your experience and your skills. If you buy an off-the-shelf package and it has some amazing fitting technology inside it and you don't really understand what it's doing, then that's potentially a dangerous situation. Mm-hmm. Another thing that people don't generally do is use information from different markets to fit. I think too many people fit individually on each thing they're trading. So they might fit one model on Eurodollar, another on cable, another on crude oil futures. Now, this is only valid if it's really true that these things are so different that it makes sense to use a different trading rule. And if you actually look at the statistics, abstracting away from costs, because obviously all these things have different costs, but if you look at the pre-cost returns, it's pretty unusual to find firm evidence that a particular set of trading rules makes more sense on one instrument than another. So generally speaking, I would default to getting everything I'm trading and assuming they're all, I mean, if you're trading just commodity futures, then I would absolutely just fit them all together and use all the data you have, and essentially trade the same model, obviously counting the costs differently, but trade the same model for all of those things, because that way you're going to be getting a lot more data because you've got a lot more things to choose from, and you're less likely to be overfitting for each individual instrument.
Yeah, that's interesting, because I think a common argument for that type of approach of individual rules for each instrument is that each has their own personality or behavior. But you're saying that if you're trading a concept or an idea, then yeah, it should really work everywhere. Is that what you're implying? Or?
Yeah, it is what I'm implying. I mean, I'm looking for rules that work over long periods of time and also over different instruments. If there's something very, very if you're trading something that's very idiosyncratic, and again, the high frequency world, which is quite a different world from the one that I'm experienced in, you have quite different microstructure effects in markets, and effects of things like different rules around who takes priority in the kind of bid offer queue when orders come in. And in that world, yes, it probably does make a lot of sense to look at each market individually. But because it's high frequency, you have a lot more data, and you have a lot more chance of actually seeing whether there's a statistically different behavior between the two separate markets. Whereas in the more low frequency world, I mean, it's a common human flaw that we like stories, and we like narrative, and it's one of the cognitive biases that I talk about quite a lot in my book. People like to think that something has its own personality, but if you then actually sit down and properly test, and it's quite rare you'll actually see that really exists, and there really is a distinguishable difference between the two. Normally, it's impossible to say whether instrument A or instrument B is really any different. So people like these stories, but it's quite rare that they're actually true.
Okay, thanks, Rob. So if we can move back to trading rules. Now, trading rules are often binary in nature. For example, price above a moving average. That's essentially a yes or no question. In your book, you suggest that trading rules should be continuous rather than binary. Can you explain what you mean by that?
Okay, so let's talk about moving averages, because we've been talking about them a lot.
Yep.
So moving average crossover used in a binary way. Let's take a 5-day and a 20-day. So your binary rule would be when the 5-day moving average crosses the 20-day moving average, then buy 1 unit. Where 1 unit is whatever it is, however many contracts you would normally buy or sell. And then when the 5-day goes below the 20-day, sell 1 unit. And you might have a separate rule for your exits. You might have a stop loss rule on your exits, which is probably going to be fairly similar to using the actual crossover as your exit rule, but maybe not exactly the same. So that's binary, and that's what most people, as you say, are familiar with. Now, a continuous rule would work something like this. So if the 5-day moving average is on top of the 20-day, then you'd have no position. So that's the same. When the 5-day moves just above the 20-day, you would buy a fraction of a position, of a unit. So it depends on how things are scaled and exactly what the rule is. But it might work out that on the first day the 5-day moves over the 20-day moving average, you'd buy 1/5 of a unit perhaps. And then if the price keeps trending upwards, you'd kind of gradually build into your position until you had a full unit, until the trade had a really strong signal. Now, if the 5-day then starts to move back down to the 20-day because the price is falling, you'd reduce your position, and at some point the crossover would reverse and you'd start selling. So you have the same sign of position on, so you're long as you would be in the binary world, you're short in the binary world and in the continuous world. But in between times, you have fractional positions on. So that's what it is. Now, if I can go on quickly to why you might want to do that rather than the binary.
Yeah, sure.
So I think there are a number of advantages. So one is that you don't need a separate exit rule. You have one rule saying, given what's going on at the moment in the market, this is the position you would want to have on. You don't have one rule saying, okay, buy if this happens and then sell if this happens. So you've kind of reduced the amount of fitting you might have to do, which is quite nice. The reason why a lot of larger hedge funds, so AHL, for example, it was before my time, but I believe they moved from a binary to a continuous signal in around the mid-1990s. The reason why a big hedge fund or someone trading any kind of large amount of money would need to do this is, if you think about it, when the signal reverses, when you go from being long 1 unit to short 1 unit in the binary system, you have to trade 2 units, right? You have to sell 1 unit to get to flat and then sell another unit to go short. Now, a unit could be, in a large hedge fund, tens of millions of dollars.
Yep.
So, in theory, you've got to do that entire trade in a day or perhaps less, which is going to cost, in a good world, will cost you a lot of money in slippage. This scaling in that I talked about is obviously a lot better from their perspective, because they'll be gradually buying as the price moves up and then gradually selling, and their market impact will be a lot less. The other reason why it makes sense to do this is most trading rules don't really work in a binary way. So if you look at trends, if the trend has been weak in the past or is only just established, you're going to have a certain expected return in the future. But if the trend is strong and has been established for a while, your expected return is going to be higher. So you actually have the actual rules themselves do work continuously. A stronger, what I call in the book, a stronger forecast. That means that you think prices will increase more. Well, if prices are going to increase more, then you should have a bigger position on. So it's it actually makes more sense, and you'll actually make more money, because you'll be putting on a much bigger position once you have a strong forecast, once a trend's been established for a while, than if you had a weak forecast. I mean, maybe let's just talk about carry for a second, because it's perhaps easy to explain, but without getting into details, carry might be something like, well, let's look at the interest rate on euros and dollars. And if we get more interest paid on euros, we go long euros and vice versa. Okay.
Yep.
So let's suppose that as an hour, the interest rates are very similar. Suppose that they're 50 basis points in both countries. So you can get 0.5% in euros, 0.5% in dollars. You're not going to have a position on. Let's suppose then that the interest rate in Euroland goes to 51 basis points, 0.51%. So at this point, if you were trading this carry system in a binary way, you'd go long one unit. Well, that's kind of stupid, right? Nothing has really changed. When 1 basis point is almost irrelevant, you probably won't want to have a decent sized position on until the interest rate differential is at least 25 or 50 or 100 basis points. So you can see why for a lot of trading rules you do get more information and stronger forecasts when the signal gets stronger, and therefore you should be having a bigger position.
Yeah, sure. So you mentioned the term forecast in there. How do you come up with these forecasts?
So a forecast is essentially a kind of output from your trading rule that's in a standard scale. And in my book, I use a scale calibrated so that the average absolute value of a forecast is 10. And the reason I chose 10 is because it means that you're mostly working with numbers between -20 and 20. And that's kind of a nice scale for human beings to kind of look at and understand. And as I said initially, I'm a great believer in having a system that you can intuitively look at and understand what it's doing. So what does that mean in practice? It means you set up your trading rules in such a way that obviously 0 means no position. You don't know what's going to happen. +10 would be a kind of a buy. You'd want to have a reasonable kind of average size long position on. +20 means that you're really confident this thing's gonna go to the moon. It's a really strong buy. So you'd have twice your average position on. And similarly, -20 means that you think this is an absolute dog and is going to go nowhere. I show in my book how you would, if you were using moving average crossovers, which is one of the two kinds of trading rules I discuss, how you would go from a moving average crossover calculation to a forecast number that's calibrated so that it's in this kind of -20 to +20 space. The advantage of that is also, if you're not using trading rules, if you're what I call a semi-automatic trader, so this is someone who is doing the forecasting themselves, so they're looking at charts or flipping a coin, it doesn't really matter, but they're coming up with an opinion themselves, a subjective opinion that they think that dollar yen is going to go up a lot, or that they should short Apple stock, they can then convert that kind of gut feeling into a numeric forecast. And then the rest of the kind of maths in my book, if you like, is completely agnostic as to the fact that that didn't come from a kind of proper trading rule. It doesn't really matter as long as you've got some way of producing a forecast on this scale. Then everything all kind of works properly.
Yeah, okay. So I'd just like to switch gears a little bit and just talk about some aspects of systematic trading. What do you think makes a good systematic trader?
The main thing about a good systematic trader, and this probably applies to a degree to real traders as well, is you should be incredibly humble. You shouldn't be an overconfident, kind of arrogant person who has a very high opinion of themselves and their own intelligence and their own brilliance, and assumes that all the fitting and back testing they're doing is going to produce some absolutely amazing system, and that a Sharpe ratio of 3 is completely attainable. You need to be the exact opposite of that. Pretty much every mistake you can make in the book is a result of overconfidence. Overfitting is overconfidence because you do some fitting, you get a Sharpe of 2, and instead of thinking, well, come on, you've got to be kidding, that's not going to happen, you think, yeah, I'm a smart guy, and it's quite right, I should have a Sharpe of 2. Being insufficiently diversified is overconfidence. Okay, I only need to trade these 3 instruments because I'm going to do such an amazing job on those. I don't need the diversification from everything else. Trading too quickly is due to overconfidence, because you might look at your trading costs and say, okay, well, it's costing me 50% of my account value every year in trading costs with this system, but I'm going to make 200% a year. So I'm still going to make 150% a year. So I'm going to be rich. And finally, and perhaps most dangerously of all, trading with positions that are too large, taking too much risk, is obviously, again, hugely overconfident, because you're saying, well, okay, the back test shows I could make 10% a year, but I can leverage this thing up 5 or 10 times, make 100% a year, and I trust the back test. It's not going to be wrong. I'm very confident about that, and I'll still be able to keep going, and nothing could possibly go wrong. And probably within a year, you're going to be bankrupt. So the most important thing is definitely to be a very miserable pessimist who thinks that they're really stupid and that they're probably going to be really unlucky. And hopefully you'll be wrong, and some of those things won't be true. Maybe you won't be as stupid as you think you are. Maybe you will have some luck. Maybe your system isn't going to be terrible. But the good thing is, if you assume that you're the worst trader in the world and you're going to be desperately unlucky and that your system is rubbish, you're extremely unlikely to end up losing money, because you're not going to put too much risk into your system, because it's not that good, right? You're not going to assume that your Sharpe ratio is going to be amazing. You're going to assume it's going to be really low. And when things turn out better than you expect, that's great. But you certainly shouldn't expect it.
Yeah, well said. In the very last section of your book, you make a statement. The statement is, the best systematic traders will be diligent when creating their systems, but lazy when running them. What do you mean by that?
Okay, so I used to work for a large hedge fund, an institutional firm that employed a lot of people to manage a lot of money. And one thing I noticed in that environment is you kind of spend a certain amount of time creating new systems, but once you've created them, you kind of, if you're not careful, you'll be out of a job. Because really, then they don't need you anymore. Then, do they? They could just say, "Thank you. Here's your golden handshake, and here's your watch, and you can go now. We don't need you now. The computer's just fine." So you end up spending a lot of time looking at the system and worrying about it, and kind of fiddling with it and meddling with it, and making changes and thinking, "Oh my goodness, there's a non-farm payroll number on Friday. We should we should de-risk the system because there'll be a lot of volatility in the markets. Now, none of this makes any sense because when you run the back test of the system, there are non-farm payroll numbers in there every single month. So the system traded around those. Sometimes it made money around them, sometimes it lost money, but on average it made money. Otherwise, you wouldn't be running that system. Generally speaking, a good system which is set up properly, isn't taking too much risk, has all the right controls in place, shouldn't need to be meddled with. You literally need. I mean, at my own system, I spend literally a few minutes a day, and that is pretty much just looking at the computer it's running at and making sure that all the diagnostics look sensible and that it hasn't broken or switched off or done something crazy. In terms of actually worrying about the risk it has or making changes, I spend almost no time on that. And the reason I can do that is I put an awful lot of work and thought into designing the system so I wouldn't have to do any work once it was actually running. So you really, I think most people make the mistake of designing a systematic system, running some back tests. Wow, this looks great. I want to make money tomorrow. I don't want to wait. I'm going to just put this thing in right now and start collecting the bucks. But the thing I've learned is it's much better to take a lot more time over designing your system, thinking about what flaws it could have, thinking about what risk controls you might want to have in place and putting those in, and then if you've done a good job, you should literally never have to touch it. That's an idealized situation, but ideally you could just employ someone to check that it's running properly every day and then go to the beach.
It sounds like a good plan.
Quite got there yet, but
so as you mentioned, you've worked in a CTA for a while. Are there any approaches or techniques or behaviours that you saw in the institutional world that would transfer well to retail traders that perhaps they don't know about?
I think the people in the institutional world tend to spend more time looking at things that people in the retail world would perhaps not worry about or dismiss as unimportant. So we've touched on trading costs a few times. In the institutional world, certainly the good funds would be obsessed with trading costs. We had a whole team of people whose job it was purely to collect data on what our trading costs were and to analyze it and to make sure that they were as we expected them to be. People in the retail world, I think if you asked the average retail trader, what proportion of your Sharpe ratio do you expect to lose in costs every year? They'd look at you like you were from Mars. But to me, that's an incredibly important question to understand because it tells you whether you're running a system which is going to be really vulnerable in periods of poor performance, because the costs you're paying are like the rent on your shop. You've got to pay those whether you've got customers or not. So if you're in a situation where you've got a shop on a nice high street location in like in Kensington in London and your rents are really high, you're going to be really vulnerable to a lack of footfall in your shops. And similarly, if you've got a trading system which is trading a lot and churning over a lot and needs 20% of your capital just to pay its costs each year, a few years of performance below where you expect it to be, and you're going to run out of money. So that's the first thing. The other thing that people in institutions obsess over is risk. And, they employ whole departments of risk management people to look at model the risks of the system and think about the risks. Now, one thing that both institutions and retail investors worry about too much is day-to-day returns. I bet if you asked any trader, how much money did you make yesterday? They'll be able to tell you the answer to that question. I'm embarrassed to say I can tell you, actually, I think yesterday I was slightly down. I think about just under £2,000. So even I know this number, but actually how much money you're making on a day-to-day basis is essentially random. And as long as it's within the expectations that the risk of your system tells you it should be, you probably shouldn't worry too much. If you have a few losing days in a row or a few losing weeks, it doesn't mean your system's broken. It's probably just noise. But I think the mistake a lot of people make is they focus too much on those numbers, and they start to worry and then potentially start making changes to their system, which would probably be the worst possible thing they could do. And I think, retail investors don't generally have as much of an appreciation that the returns are just noise. And in an institutional setting, the guys who are actually running the systems probably do have that appreciation, but unfortunately their investors don't. So you've obviously got the classic situation where if you have a poor couple of quarters, your investors will be saying, well, this is bad, we want to pull money out. Fortunately, at least in the CTA industry, I think most investors have got an appreciation of the style of the strategy. It is a strategy where in a lot of quarters you'll lose money, but every now and then you'll make it all back and then some. And so they kind of understand that risk profile. But if you have investors that don't, then you're going to be behaving the same as the retail investor. You're going to be, seeing money pull out, starting to panic, starting to meddle with your system, and essentially then you're no longer a systematic trader at all.
Mm. Okay, thanks, Rob. That was some great insights there. So I'd just like to finish up with some quick closing questions. The first one: what's the biggest lesson you've learnt through trading?
Through trading systematically, I mean, I've learned that I am not a good trader, and that's why I let a system do it for me. And I think very few people are actually cut out to be good traders. Our brains are just wired wrong, and so I think most people should consider following my example and trade systematically.
What's the best trading advice you've ever received?
I think in my book I talk about a conversation I had with a more experienced trader in my first job, and he told me that there are only three things you need to worry about: how much do you like the position, how much risk can you cope with, what losses can you cope with, and what risk does the position have. And if you understand those three things, that essentially is all you need to design a good systematic trading system. So at the time, I didn't appreciate what amazing advice that was, because I thought, what? But it was very good advice, and if the guy's listening, I'll say thank you now.
Great. What's your one tip for traders to take it to the next level?
I think go back to basics. I see a lot of people trying to run before they can walk and doing incredibly complicated things with neural networks and all kinds of sophisticated trading models. I would go back to basics. I would create a really simple model with just a few moving averages or whatever you're comfortable with. Understand how that works. Get comfortable with how it behaves. Get everything working. And then if you do want to make it complicated, then you can, but usually that's not necessary.
Okay. And what's your favourite trading book?
Oh, now that's difficult, because whenever I say I'm going to offend people.
Or you can say a couple if you like.
Exactly, yeah. I would go for Trading Systems and Methods by Perry Kaufman,
yep.
Which is a book that has so many pages I can barely lift it. And if there's a trading rule that's been invented and is any good, it's probably in there. And my second choice would be pretty much anything written by Jack Schwager. So Jack Schwager on futures would be a great book. Mm-hmm. So yeah, there's two.
Excellent. And what's the best way for listeners to get in touch with you?
You can go to my blog, which I guess you could put a link to, but it's quapac.blogspot.com.
Yep.
And my email's on there. And if you want to email me and ask for advice or start a conversation, I'm happy to do that.
Yeah, cool. I'll have a link for that on the show notes page, so that'll be easy to find. So thanks so much for chatting with us today, Rob. Is there anything else that you'd like to mention before we wrap up today?
I'd just like to wish all the listeners the best of luck with their trading, and remember that one down day doesn't mean that your system is broken.
That's great. Thanks, Rob. Well, thanks for spending time with us today and sharing some valuable insights into trading system development. And I highly recommend that people go and check out your new book. It's a great read. And I wish you all the best for the future.
Thank you very much, Andrew.
Thanks, Robert. Bye. Some interesting insights from the chat with Robert this week. Here are a couple that I picked up. Firstly, the challenges of walk-forward testing. Robert highlighted issues with rolling window or walk-forward analysis, especially around the length of the window that's used. If we're using a rolling window of, say, 1 or 2 years, which is a common approach, is that length of time really long enough to determine one rule or variation is better than another? Robert suggested that it probably isn't and provided an approach where you start with an expanding window until you get a window size that provides statistical significance and then use a rolling window from there. He also mentioned a study which suggests that choosing the best set of rules or values in a walk-forward test is perhaps not the best approach and offered some suggestions that could provide better results. An interesting statement that Robert made was a very easy way to avoid overfitting is to do no fitting at all. When he first said this, I found this statement quite amusing, but it really is a very interesting idea. I mean, if we're using trading concepts that have been proven to work, what is fitting really doing for us? Robert's approach to using an average of the rules was a very interesting concept because we just don't know which rules are going to work best in the future. Another idea I found very interesting was using continuous trading rules instead of binary rules. The use of a continuous rule not only tells you when to get in and out of trades, but can also be used to drive position sizing. In the example Rob gave of the moving average crossover rule, you would enter the trade with a small position when the crossover occurs, and only when the instrument starts moving in your favour do you increase the position size. And when the moving averages start moving back towards each other, then you would reduce the position size. So I thought that was quite an interesting idea. Anyway, if you'd like more info on this week's episode, head over to the show notes, bettersystemtrader.com/26, and you can get more details there. Anyway, that's it for this week. I hope you enjoyed the chat with Robert, and thanks for listening to Better System Trader. I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.